Thank you so much for having me here, Commissioner Weejan. It's really a pleasure and honor to be with all the panelists and the guests in this room, and thanks to the GMAC for organizing this hearing as well. So my name is Houman Shadab. I'm a professor at law at New York Law School. My research happens to focus primarily on derivatives and more recently cryptocurrencies such as Bitcoin. So it's sort of serendipitous to be here today. I was asked to speak about the regulatory challenges from the CFTC's perspective facing Bitcoin. And basically, I see them as three. One, sort of what is Bitcoin from the Commission's perspective? What's the nature of it? Second of all, how do we apply the traditional distinction between futures and forwards to Bitcoin derivatives in the cases where it could be ambiguous? And finally, how do we regulate not derivatives that reference Bitcoin, but derivatives that are executed and cleared and traded and settled and so forth through the blockchain, through the Bitcoin network or protocol. So the first point I want to make is that Bitcoin is best understood not actually as a digital currency, but as a digital commodity. Okay, certainly the primary application or use right now of Bitcoins, perhaps besides investment or speculative purposes of owning it itself, are for payments, and there are a growing number of merchants that accept Bitcoin, and that certainly is an important aspect of what it's used for. But Bitcoin fundamentally, as Jerry Brito just noted, is a method of transmitting messages over a blockchain, what's also called a distributed ledger network. And because of that, many software developers right now are currently developing applications that go beyond payments, including things that are called sort of smart contracts, which essentially allow two parties to trade in an automated fashion, which is also decentralized, secure, and sort of basically publicly verifiable through the blockchain. So because of all that, I think that it's best to view Bitcoins as essentially an exempt commodity, more like gold and silver, and less like excluded commodities under the Commodity Exchange Act, such as currencies or other financial interests. I think to think of Bitcoin as just a currency would be to think of the internet just like a network for sending email. It's true, but it's just too narrow. And perhaps
I don't mean to throw you off, but you made that distinction between excluded versus exempt. Help us understand a little bit more why that might matter.
Yeah, I think it might matter from the perspective of regulators because, first of all, it wouldn't bring into the equation sort of regulators, including banking regulators and monetary authorities that may be more concerned about currency type issues. Second of all, for the more nitty-gritty type details with respect to the Commodity Exchange Act, being an exempt commodity pretty much means that Bitcoin would fall and look more like a intangible commodity that can be physically delivered as opposed to, let's say, a currency. So we wouldn't think, when we think about regulating maybe Bitcoin swaps or Bitcoin's futures versus forwards, I think what we think about are the deliverability aspects of it and not so much whether, for example, a Bitcoin swap falls under something that looks like the NDF classification or something that looks like the Treasury exemptions for physically delivered certain FX futures and forwards. So it's subtle. At the end of the day, it might not matter too much for how the regulatory structure wraps around Bitcoin, but I think that for a bigger picture idea, it is sort of important to classify and just get the conception right about what exactly Bitcoin looks like from your commission's perspective. And so given that's the case, the sort of second challenge is how do we apply that traditional distinction between futures and forwards to this digital commodity, Bitcoin? And often we distinguish, or courts and the commission distinguishes between futures and forwards based upon whether or not they're deliverable, physically deliverable or cash settled, whether or not the contracts are standardized, whether or not the platform serves as a central counterparty, and whether or not maybe the contracts are fungible as well. That's important, of course, with respect to futures and forwards, because forwards are basically do not fall within the jurisdiction of the CFTC, certainly not like futures contracts. And if you look at some of the platforms that are currently being developed with respect to trading Bitcoin derivatives, some of them sort of fall in between And it's hard to determine, I think, whether or not certain contracts are futures for Bitcoin or maybe forwards. And for example, so maybe one case study here is setting jurisdictional questions aside, is the ICBIT or ICBIT platform, which calls itself a futures exchange, which says it's selling Bitcoin futures, yet nonetheless, and the contracts are relatively fungible. They're basically 1, 2, 3 month standardized futures contracts of referencing Bitcoin. On the other hand, the platform doesn't serve as a central counterparty, and it entails physical delivery. So maybe that kind of contract, that kind of platform, again, setting aside jurisdictional issues, it may or may not fall under the scope of jurisdiction of the commission, and something to think a little bit more deeply about, recognizing, though, that even though Bitcoin is digital and to that extent maybe intangible, it can still be physically delivered, just for the same reason that the commission recognizes physical delivery in a sense of other intangible commodities, such as pollution rights, for example. So that is my second general regulatory challenge. And finally, all the foregoing that I've talked about really applies to derivatives written on Bitcoin, whether it's a Bitcoin futures or Bitcoin swap or Bitcoin forward or option. But there's another type of sort of Bitcoin derivative, and that's really a smart contract, a derivative that's enabled and basically that goes through the Bitcoin blockchain system. And what's interesting about these contracts is that, like many other aspects of the financial markets, they're sort of programmable ahead of time. So maybe if you had a Bitcoin, or excuse me, a blockchain futures or a smart futures contract, you could program, because futures are already sort of by definition sort of standardized, all of the terms of the agreement except for the price, so the quantity, the maturity, and so forth, and then maybe the internal processes of the software application that applies to the blockchain could help determine the price. And although many of these smart contracts platforms and applications are currently works in progress, many companies, organizations are developing the underlying code to implement these types of agreements. Two sort of aspects of these, or 2 or 3 aspects of these that programmers or developers are starting to identify as being important are: 1, multi-signature authentication to sort of verify and authenticate different aspects of the agreement or different types of the performance as the contract proceeds. Escrow services as well to sort of segregate and safeguard parties' capital or other assets, and sort of and oracles, what's called an oracle, which is basically a part of the application or a separate one that sort of interacts with the outside world to essentially incorporate or provide a data feed to the agreement, so that it sort of operates properly. And certainly in the financial instrument space, we could see how interacting with the outside world, including prices and so forth, would be important to execute that. Now, certainly the derivatives markets are very already use a lot of software and they're very tech-enabled to begin with. But nonetheless, I do think that the Bitcoin blockchain could provide sort of unique functionality, unique advantages that currently are not fully being utilized or even available through traditional technological means, if that's not a bit of an oxymoron. One is maybe because the blockchain doesn't use intermediaries, or maybe fewer intermediaries at least, the transactions could be traded, cleared, and settled much quicker, and maybe at a cheaper cost as well. Furthermore, you could probably build in, let's say, the 23 core principles that futures exchanges are required to abide by into the very code itself. And if you embed those types of rules into the agreement ahead of time, one question is, well, maybe that these types of transactions should qualify for an exemption under traditional rules that would otherwise be applicable to a contract that essentially provided for, let's say, future delivery of a commodity, whether it's actually physically delivered or cash settled. Finally, another potential advantage of a Bitcoin futures, a blockchain futures, is that it could actually allow for integration with other markets better than current futures markets do, in the sense that if there is sort of one universal blockchain or blockchains that interact with each other on a global basis, it could allow for futures markets to be more integrated with, let's say, securities markets, and even for futures markets to maybe be more integrated with commercial markets. And you could imagine at some point that a physical producer of agriculture would automatically purchase, in a sense, or be entered into in order for a futures agreement if the projected price of a commodity goes below a certain point in the future. So my last sort of just conclusion here is that given that it may be possible, and certainly many of these concepts are sort of potentials and projections about what technology may look like in the future, which is always sort of inherently difficult to do. But given that it may be possible for regulatory policy objectives to be achieved through the blockchain, to be achieved through software, through code, and embedded into the contract rules themselves, the Commission may want to think about or consider exempting these types of agreements from the full scope of the regulations to sort of balance consumer protection, market stability, and systemic risk with innovation and progress. So thank you so much for hearing my remarks, and I really look forward to the discussion.
Thank you, Professor.